Top 10 Trading Rules. Every trader must follow. Introduction. Trading looks simple from the outside, just buy low and sell high. But in reality, most traders lose money because they ignore discipline, emotions, and risk management. Studies show that over 90% of traders fail within their first year. Why? Because they treat trading like gambling, not like a business. This book will give you the top 10 trading rules that professional traders follow. These rules won't guarantee overnight success, but they will protect your capital, improve your mindset, and give you a clear roadmap toward becoming a consistent trader. Rule 1. Have a trading plan. A trader without a plan is like a ship without a compass. A trading plan defines your strategy, trend following, breakout swing, etc. Your entry and exit rules, your risk per trade, your profit target. Example. Instead of saying, I'll buy if the stock looks good, a professional plan would be, I will enter when the price breaks above resistance with volume, set a stop loss below the last swing low, and risk only 1% of my account. Key tip. Write your trading plan down. If it's not written, it's just a wish. Rule 2. Risk only what you can afford to lose. One golden rule. Never trade with money you can't afford to lose. Don't use rent money, loan money, or emergency funds. Trading capital should be risk capital, money you're willing to lose without affecting your lifestyle. If you have Rs1,000,000 and it's your emergency fund, don't trade with it. Instead, save and build a separate trading account. Protect your financial life first. Trading is risky, but losing your financial stability is worse. Rule 3. Always use a stop loss. A stop loss is like an insurance policy for traders. Without a stop loss, one bad trade can wipe out weeks or months of gains. Professionals focus on controlling losses, not chasing wins. Example, if you buy a stock at Rs100, place a stop loss at Rs95. Even if the stock crashes, you'll only lose Rs5 per share instead of Rs50. Key tip. Respect your stop loss. Don't move it lower, hoping the market will come back. Rule 4. Follow risk management. 1. 2% rule. Even with a great strategy, poor risk management leads to failure. The 1-2% rule. Never risk more than 1-2% of your account on a single trade. This ensures you can survive a losing streak. Example, if your account =sign Rs1,000,000, risk 1% Rs1,000 per trade. Even after 10 losing trades, you still have Rs90,000 plus to recover. Key tip. Position sizing, number of shares contracts, should always be based on your stop loss and risk percentage. Rule 5. Control your emotions. Fear and greed are a trader's biggest enemies. Fear makes you exit too early. Greed makes you overtrade or hold losers too long. Emotions cause impulsive decisions that break your trading plan. Example, you buy at Rs100, it goes to Rs110, but you panic and sell at Rs102 because you feared losing profit. Later, it goes to Rs120. This is emotional trading. Key tip. Trading is 80% psychology, 20% strategy. Train your mind like you train your skills. Rule 6. Don't chase the market. FOMO, fear of missing out, is dangerous. Chasing a moving market often results in buying at the top or selling at the bottom. Patience is a trader's strongest weapon. Example, if a stock shoots up from Rs100 to Rs110 in minutes, don't jump in out of excitement. Wait for a pullback or proper setup. Key tip, the market will always give new opportunities. You don't need to catch every move. Rule 7. Trade with the trend. The trend is your friend until it ends. Trading against the trend is like swimming against the current, exhausting and risky. Use tools like moving averages, higher highs, lows, and support resistance to identify trends. Example, if the overall market is bullish and the stock is making higher highs, buy dips instead of trying to short it. Key tip, identify the bigger trend, daily, weekly, before taking intraday or swing trades. Rule 8, keep learning and adapting. Markets change. What worked last year may not work this year. Constant learning is key to survival. Read books, follow mentors, backtest strategies, and review your trades. Example, a strategy that worked in a trending bull market may fail in a sideways market. Adapt accordingly. Key tip, keep a trading journal. Note your trades, mistakes, and lessons. Rule 9, avoid overtrading. More trades don't mean more profits. Overtrading leads to unnecessary losses, stress, and bad decisions. Professionals wait for high-probability setups. Example, instead of taking 20 random trades a week, focus on 2-3 high-quality setups with clear risk-reward. Quality, quantity, patience pays. Rule 10. Protect your capital at all costs. Your first goal as a trader is capital preservation, not profits. If you lose all your money, you're out of the game. Professional traders think like survivors. They protect their capital first, and then grow it. Example. Warren Buffett's rule. Never lose money. Never forget rule #1. Key tip. A small loss today protects you from a big disaster tomorrow. Conclusion. Trading is not about making money fast, it's about staying in the game long enough to grow consistently. If you follow these 10 rules, you'll avoid major pitfalls. You'll build discipline. You'll think like a professional, not a gambler. Remember, trading is a marathon, not a sprint. Stay disciplined, keep learning, and protect your capital. That's the real secret of trading success.